Hello and happy Friday, and welcome to the inaugural edition of the video version of Barcom Asset Management Weekly Commentary. I hope you like it, and at the same time, if you have any suggestions on how this might be improved, I would welcome those suggestions. All right, meanwhile, it's been another busy and consequential week in the financial markets. Investors remain jittery, mostly over AI fears that some are beginning to call AI derangement syndrome, and I think, unfortunately, there may be something to that. Still, whatever the cause, fear drives people to get out of what they perceive as harm's way, and asset prices decline as a result. AI fears present a unique challenge. Earlier this week, a research report from Citrini Research, one that was clearly labeled as a work of fiction, helped send stock index tumbling on Monday. The blog post was framed as a research memo from the future, and it laid out a dystopian view of AI's future effects. The blog went viral, and it created near panic among some investors. Whenever new technology becomes disruptive, the initial knee-jerk reaction is doom and gloom. When digital photography became mainstream, Kodak nearly went out of business, and the entire film processing infrastructure industry collapsed, along with many jobs. Fears then spread that this dynamic would sweep across the entire economy. And instead of being a job killer, digital photography ultimately produced a new and much larger industry infrastructure employing many more people than the older technology. It's an anecdote. In the 1990s, after a friend of mine accepted a job as a paper salesman with a major paper company, he called me one day in a panic. The internet was then becoming ubiquitous, and at that time everyone was predicting paperless offices, and he was certain that he was soon going to be out of work. As we all know, instead, the internet has greatly increased office demand for paper. Online shipping from Amazon and other companies likewise has boosted, by a large margin, demand for paper products. And rather than losing his job, my friend went on to enjoy a long and very lucrative career. Folks, technology redefines jobs. It doesn't destroy them. In the short term, disruptions occur, and there's concerns about job losses in the short term. Today, for instance, Block, symbol XYZ, a financial technology company that enables credit card payments through its Square ecosystem, announced layoffs of nearly half their workforce. And the stock is up 15% on that news. Greater productivity with less cost. Problem is, it's far easier to identify where job losses may occur than to envision where and how new jobs are going to be created in the future. And undoubtedly, they will be created. Industries we haven't yet imagined, as in the past, will emerge in the coming years, likely putting millions to work. When Anthropic recently announced its cloud AI can write code, fears spread that the 4.8 million engineers in the country would soon be out of work. The reality is we currently face a significant talent shortage in that field. Now, Anthropic's cloud AI, Claude, AI, is now writing virtually 100% of the code for its own developers. That doesn't mean those developers and engineers are out of jobs. It means AI is transforming software engineer, and it's predicted to make engineers 10 times more productive than they have been. This is one reason Jensen Huang, chairman of NVIDIA, reiterated this week on CNBC his earlier claim that the idea that AI will replace software is the most illogical thing in the world. Logic isn't the prevailing sentiment, however, in the markets these days, and none of this has caused market fears. IGV, the iShares Expanded Tech Software Sector ETF, remains down nearly 25% on the year despite great earnings. Speaking of NVIDIA, that company announced earnings on Wednesday. They were fantastic, widely beating expectations. In fact, the company experienced its fastest growth rate in 4 quarters and exceeded Wall Street expectations by the widest margin in 2 years. Guidance for the first quarter, likewise, was very strong. And shortly after that announcement, which was after market hours Wednesday, The stock in after-hours trading was up 5%. Sadly, those gains didn't hold. The stock ultimately closed down more than 5% in yesterday's session, and today it's down another 3%. From its post-earnings after-hours peak Wednesday evening through midday today, the stock is down 15% after one of its strongest earnings quarters in years. Reactions like this is what is giving rise to the phrase AI derangement syndrome. Today's sell-off is also being fueled by some economic data, some unfortunate economic data. The Producer Price Index, PPI, rose significantly more than expected in January. Core PPI increased 0.8%, well ahead of consensus estimates of 0.3, and it was the highest reading since March of 2022. On a year-over-year basis, wholesale prices accelerated 3.6%. There's concern that this is going to trickle down to overall inflation numbers. Now, there's good news to focus on despite the rise in PPI. Federal Reserve Governor Stephen Miron said he believes the Fed needs to cut rates by a full percentage point in 2026, and he's not concerned about private credit risks, concerns that today are helping tank financial stocks. In other news, mortgage rates this week hit their lowest level since September 2022, and with regard to earnings, with 94% of S&P 500 companies having reported fourth quarter earnings, most have beaten expectations. Earnings have risen an average of 15% over the same quarter a year ago, and this marks the fifth straight quarter of double-digit earnings growth. And while the software index is deeply in the red this year, along with a swath of tech companies, it's based on fears that AI is going to destroy their businesses. CEOs of many of these same companies have publicly stated that they are, quote, playing offense with AI, meaning they believe AI will enhance productivity and profitability, not undermine their companies. Regardless, there remains a great deal of uncertainty surrounding AI and its potential impact on various industries and companies, and investors still appear to be in a sell first, ask questions later mode. It may take several weeks for this to shake out and for some greater clarity to emerge so we know what the longer term, at least for this year, implications will be. Short term, I think we're going to be in for more volatility, maybe a little bit more to the downside, but I do think on balance, given the various tailwinds that will be impacting the economy this year, that it's going to be a positive year and it could potentially be a strong year. There's a lot going on, a lot to try to sort out, and we're going to do our best, as always, to keep you up to date as often as we can. Thank you, and in the meantime, have a wonderful weekend.